Okay, I'd like to thank everyone for attending. This webinar is going to approximately last about 30 minutes, I'd say, and I'll open it up for Q&A at the end. So to start off, my name is Scott Smith. I'm the Senior Technical Analyst here at Briefing.com. I've been here for just over 10 years now, and you can see a lot of my work, mostly technically oriented all over the website. Everywhere from swing trading column to technical commentary on in play, as well as our proprietary focus lists regarding liquid momentum, emerging growth, value, and I also post numerous day and swing trading opportunities on our Briefing Trader service under the alias of Bluechip Trader. Okay. Let's see, there seems to be some audio feedback. Let me just lower this down here. All right, so today's webinar, we're going to be focusing mostly on the Technical Analysis Scans page. That is also known as the TA page scans. And for those of you who are not familiar with it, or if you're new to Briefing Trader, the first place you're going to find the TA scans is under the Investing and Trading drop-down menu, under the Technical Analysis section, and it says TA page scans. And when you click on that, it brings you to this page right here. This page has to be updated manually each day by me. I have to run through all these different types of scans. And so I usually try to get it out, I'd say, within an hour or so after the market closed. 95% of the time throughout the year. Obviously, it depends on my schedule. If I have to run out early, or if I have vacation or something like that, I usually have a backup or something. But it will get done usually before the morning the next day on those rare occurrences. But for the most part, you can expect it to be published about an hour after each close each evening. So I'm going to try to fly through this as quick as I can and show some examples. Particularly, I want to focus on how I use it. So the reason this came about, and this is kind of like a conglomerate over 10 years, is, as a technical-oriented trader, you have to scan through a lot of charts each night. You have to look at the major indices. You have to look at each sector. You have to look at individual stocks, and you have to find patterns that look good. Well, I've been doing this for about well over 15 years, I'd say, and there were just certain patterns that just repeat themselves over and over and over again that I wish I could just zone in on and just kind of focus on. And so this is basically how this entire page was developed. And so these scans, that's exactly what they are. They're basically focusing on price patterns that over the years I have found to be set up for really nice trading opportunities. They are not back tested. However, there is a certain amount of discretion that has to come along with it, and this is going to be a recurring theme that you're going to see among me describing a lot of these setups. Is you have to keep everything in context. So to start off, I do want to go back to the PowerPoint here. All right, so again, it's not a mechanical system. You cannot blindly buy or sell any of these signals that you see. That is just, I really can't emphasize that enough. It's really designed just to cut down the time that you're doing researching stocks and finding opportunities that exist the next day. A great example, just to change gears for a moment, would be suppose someone told you that you had to buy this stock because it had a ridiculously low PE, say it was like below 10, single digits PE. I mean, would you run out the next day and just start buying up that stock as much as you can? Or are you actually going to take the time and start researching what the company does, find out if it has any revenue flow, look at this sector, compare it to its peers. Is it a leader or a laggard in that field? Would you even question why the PE was so low? Perhaps there was like a legitimate reason for that. There are certain things that you have to, if somebody gave you a fundamental piece of information, you wouldn't just trade it in a vacuum, and you'd actually probably do more research on it. And I think that's where technical analysis kind of gets this bad rap, is that people see a certain price pattern, and they immediately think that it has to be successful, and they ignore the fact that it can't be taken by itself, and it can't be traded in a vacuum, and you have to take it in context of the bigger picture. And the more you can do that with your analysis, you're just putting the odds of success. You're putting momentum in your favor, or you're putting an extreme in your favor. You just have to get really used to doing that. You have to kind of take the bigger picture as a whole with all these setups. Hopefully I made this point across. I want to get moving on to some examples. All right, so we'll go back to that TA page scan. Now I'm going to start from the bottom up here. So down at the bottom here we have the Bluechip ETF Signals. And this is a proprietary scan that I came up with a few, I'd say about 2 or 3 years ago. It basically, I wanted something that would tell me where, which way the momentum was focused on. So using just the Spider ETF SPY, I created a system of moving averages, MACDs, where the price is in relation to the prior week's highs and lows, the monthly highs and lows, the daily highs and lows, and it would basically tell me if the momentum at the time was bullish, flat, or neutral, or if it was somewhat in a downtrend. And I color coded this recently. And basically right now you can see that as of today, or as of April 10th, I should say, we've been in more of a bearish corrective environment. In other words, the momentum is down. All right, so with that in mind, I immediately know going forward that I should have some sort of bearish view in mind, that if I'm going to take a long in any of these positions, that it's going to be counter trend, counter momentum. And that is huge. When you get something like that, you want to trade less size, or you want to take your profits quicker on the long side. This is all about risk management. So that's basically the first way I approach the market, is to look and see what side of the momentum that I'm on. The next one here is called Bang for Your Buck, and this is a updated focus list, updated weekly. And essentially, these are a group of names, about 40 to 50 names of stocks, that if you have no clue, if this is your first time trading and you're just trying to find the momentum names in the market that you really want to jump on board, this is the go-to list that you should be focused on. These 50 stocks should be the stocks that you look at constantly, day in, day out, for any sort of trading opportunities throughout the day. They have high average true ranges, usually of more than $2. They have good liquidity, usually in the $1 million or more range, and you're guaranteed to pretty much see the stocks move, significant amount of points on a daily basis, or especially on a weekly basis. Of course, these are kind of like higher octane names. So if you're more geared towards, say, like trading the GEs or the Intels of the world, those are always there. But if you're looking for more of the real true momentum, high growth names, then this is a group that you have to be focused on. You're going to see a lot of if you're part of the Briefing Trader service, you're going to see that many of our traders do focus on a lot of these different stocks, different opportunities throughout the day. Zippers. So this came about recently in January. This is only about 3 or 4 months old. There was basically a subscriber called me up and said, we don't focus enough on lower price stocks. I'm not particularly a fan personally of lower price stocks. I prefer stocks trading 50 and higher, even more so 100 and higher. So I developed a scan of identifying stocks underneath $20 that were displaying strong weekly and daily upward momentum. Most of these stocks are in established uptrends already, so it's really just a matter of either jumping aboard or doing some sort of research on them, or waiting for some sort of minor pullback to say like a 20-day moving average or a 50-day moving average, to try to find some sort of trading opportunity in there. It's not really my particular style of trading, but it's out there in case you're interested. You can see the next 4 scans are all moving average alerts: 20-day moving average, 50-day moving average, 100-day moving average, and 200-day moving average. Pretty self-explanatory. However, I do look at these every single day. I'd say it's actually one of the first things I do is I just glance through them real quick and try to find, just get myself familiar with any of the names. And if I see any repeats or et cetera, I kind of just want to, or a particular group or industry, something like this stands out to me. IBB, that's the biotech ETF sitting on the 200-day moving average. That to me is something that I have to be focused on. I might want to start looking at biotechs for potential bounce. IWM, IWO, two other ETFs on the small cap side. Those are at the 200-day moving averages, or close, or within the proximity of the 200-day moving average. That tells me that small caps, knowing what they've gone through already the last few weeks, that you might start to see some the downside might be limited in these names, and they might start seeing some squeezes or bounces in these stocks. 100-day alerts. It's not that popular. You're not going to find it in a lot of textbooks. However, what we've discovered is when we came out with our proprietary focus list, the liquid momentum and the emerging growth stocks and the value list stocks, we noticed that a lot of times when these stocks break down below the 50-day moving averages, they fall off the radar, and people just kind of just to avoid watching them below the 50-day moving average. However, when they get to the 100-day moving average, they tend to display a very strong support level there. And it kind of falls right between the 50 and the 200 days, so it's kind of that no man's land type of thing. But the 100-day moving average, especially for any of our focus list leaders, you definitely want to be paying close attention to play some sort of bounce, or maybe a new uptrend beginning or stabilization. 50-day obviously is what it is. It's highly popular, and if you ever see stocks that can't hold the 50-day moving average, you have some sort of red flag going on there. And the 20-day is just obviously a shorter momentum average to focus on. Tight consolidations. This is basically a few weeks of narrow ranges. And here, this again came from a subscriber who wanted to be focusing on just stocks that weren't moving. We're in some sort of ranges for multi-weeks or even months. I could show a few examples here. I do have some charts up. So right now you can see AMT and CTB. If we look at the charts of AMT, you're going to see this pattern right here. The stock's been range bound for a couple of weeks between 80 and 82. CTB, we can also see that there's another range going on here in this stock between 25 and say 23, and that's basically what this scan is going for. Some prior examples in the past of these tight consolidations, I believe we had CRK was one of them. Back during this time here, it was one of these momentum plays, one of these tight consolidations for multiple weeks, and you can see it broke out real nice. One of the ways to play this, you have to be a little bit more patient with it, because usually you need some sort of event or trigger like earnings or an upgrade or downgrade to really trigger some sort of breakout or breakdown from these ranges. So you have to kind of be patient and just keep them on your radar. I guess if you're an option trader, you can do some sort of out-of-the-money spreads or iron condors or something like that. I think that's the reason why I got requested to look that up. Let's see. Another example of recent ones was also Zillow. It showed up on the tight consolidation scans back in late February, early March. I think Devon Energy was another one that showed up in March as well in this little range here. So it's just something to think about if that's your style of trading. All right. If we go back to the TA scans, wide range breakouts and breakdowns. So essentially, these are going to be exactly what they say: breakouts and breakdowns above a key resistance area or below a key support area. Now, there's a couple ways to view this, or at least how I approach it. First off, I'm always looking at the number, the absolute number of the results of these scans. To me, if I see more breakdowns than breakouts, well, then I know that the market's going to be, generally speaking, the market's under some sort of distribution behavior, and vice versa. If there's more breakouts than breakdowns, well, then I know the market is into some sort of accumulation pattern. And so that's basically the number one way that I look at it. All right. The second way to look at it is just to look a little deeper and see if there's any sort of relationship among the stocks. Are there certain sectors breaking out? Are there certain ETFs that are breaking out? Right here on the breakouts, I see CRK, GDP, NOV. These are energy-related stocks. Down on the breakdown side, nothing really jumps out at me right at the moment. But if you looked at back a few weeks ago, there were a ton of biotech names. There were a ton of internet stocks just getting showing up on this scan and getting hit. Let's see. The third way to look at these breakouts and breakdowns is actually timing the market itself. So this kind of comes into where I started off saying you have to pay attention to what's going on in the bigger picture. Let's see if I can get rid of this. There we go. So looking at the bigger picture, we can see that the market had corrected in early February, late January, as these spiders, got hit pretty hard. And as it started to turn here in early February, there was a possibility that we were getting some sort of recovery effort going on. Well, sure enough, on where was that? February 6th, 7th, and 8th, the wide range breakouts. We started seeing a lot of names amongst the energy sector and amongst the natural gas sector. So, natural gas under this XNG index, it was actually showing a lot of relative strength as a whole. It was actually above the 50-day moving average. So remember, the S&P was breaking down aggressively here, but this sector was actually holding up pretty strong. We also saw some utility stocks that were rallying into late January, early February. This whole time the S&P is getting hit aggressively hard at that. So you have relative strength amongst utilities and natural gas names. So sure enough, when the market did start rallying, we started to see some wide range breakouts, particularly amongst names. Let's see, like I think it was Baker Hughes. So Baker Hughes in late January, early February started breaking out here on February 6th, February 7th, February 9th, February 11th. So these are good buying opportunities. They start telling you what's going on. We can also see it in CXO, Contra Resources. Here's February, and it started rallying back up real strong. We also saw it amongst PTEN. Nice solid breakout here amongst above this these January highs. Strong breakout. We see Exelon Corp. This is a utility stock. Again, early February, price started breaking out. PDS was another one. GTAT. GTAT, I believe, is actually on one of our emerging growth lists. And this was a nice strong breakout out of a base here above $11. So again, hopefully you can see this point here that I'm trying to make is that the breakouts, you kind of want to you don't just want to take them blindly when the market's say breaking out to new highs and it's overbought. It ran up for a couple of days in a row. You really want to you don't want to be buying breakouts because you know that the market itself is going to be prone to a pullback. However, when the market's in a correction, and it starts rallying and you think there's a chance that it's going to be sustained for a couple of weeks, you really want to start focusing on these wide range breakouts because those are going to be your new leaders in that next bull cycle. So right now you can even take a look at the market, and I'd say we're kind of in a similar situation here in April where the market's undergoing some sort of correction. And we're kind of in this no man's land where we're a little bit too oversold to extreme to the downside. It looks like we're bouncing. But you can't really tell if the market's going to just embark and push higher to fresh April highs here or go higher in May, or if it's just going to chop around and break down again. So this is where I'm going to be really focused on the breakouts and breakdowns again, and I'm going to try to find some sort of theme or leadership evolving here so you can kind of jump aboard that particular group or sector. Right now I don't really see any signals happening, so just kind of take it for what it is. If we go back to the scans here, overbought, oversold. Okay, so these are basically stocks that have moved aggressively out of their 5-day range or broke down below a 5-day low. It's usually some sort of extension move. So for example, if we were just to look at say ATI and CRK, you can see ATI for that going into today, it's well extended above a 5-day range over here. CRK was the other one, and again, this was as of yesterday, so you can see that it's well above like a 5-day range. It's not really a breakout, so to speak. It's really based upon an extension of the move, and it's a significant moving away from the 5-day range. Now, the way to trade these, or at least what I've seen, is, again, you cannot go blindly out and just start shorting these overbought names or buying these oversold names. In fact, in most instances, I've seen these things continue on the momentum for multiple days. Now, the only way I would actually fade them is if I did see some sort of gap reversal. If an overbought name gapped higher and began to sell off and get into negative territory, well, then I might consider it a a short-term fade. Again, you're going counter trend on that, so you really have to have your money management rules in place there. And vice versa for the oversold candidates. If a stock gaps down, you kind of want to hope the broader market or that sector is also in some sort of oversold condition, and the whole market as a whole is set up to rally, and that's going to be a nice gap down reversal play. But again, you take into context where the stock has come from, that you're playing a bounce. You probably don't want to do full size, and you definitely want to try to take profits as quick as you can in that, and not hang around too long, or at least have some sort of runner or trailing stop in place, just in case it does turn into a much bigger reversal. Some examples I can give of that. So on March 14th, this is Rand Gold. It's a gold stock. So going into March 14th, this was an overbought candidate up here at $72, and it would have looked like something like this the day you looked at it. So again, you could kind of see it's well extended, a wide range bar above the 5-day range highs. It's above this upper Bollinger Band here, and it probed the prior day's high, reversed into negative territory. Something like that you can consider a short candidate if that fits into your strategy, fits into your wheelhouse. The one thing you're going to notice too, I just want to bring this up quick, is I'm not focused at all on any of these scans on the traditional technical indicators, MACD, RSI, stochastics, etc. By all means, use them as confirmation for these signals, Bollinger Bands, etc. Again, this goes back to, don't just take one of these indicators and signals and trade them in a box. Definitely apply negative divergences or sector behavior with these scans if you're going to trade them. You got to do as much as you can to get that edge, to put the market, to put the momentum into your, to find those best opportunities, the low risk opportunities. You want as many confirming indicators as possible. Another good example was April 3rd, just recently. So here is Foot Locker, and you can see Foot Locker. Here's April 2nd. So for the April 3rd scans, Foot Locker was an overbought candidate. Again, an extension above a 5-day trading range, and it failed off a high and reversed pretty hard. So this is a stock, if you whether you're day trading or whether you were swing trading, you can consider for a short-term short pattern. And sure enough, it did start breaking down here with the rest of the market. Now, take into context what the market was doing that day as well. If we look at the SPY, going into April, this is April 2nd right here, you can see the SPY was actually right against the March highs. We had almost 3 gaps in a row, or 4 gaps in a row, I should say, where the market had made a significant rally. You could probably look at any indicator and make the argument that we were kind of maybe short-term overbought, and that there was going to be some sort of pause going into the next day into April 3rd. And sure enough, when you started to see failure, you could have shorted maybe some Foot Locker up here. Another example of a stock could have been Macy's was one. April 4th here, you can see that it probed the highs and reversed pretty hard for about a $2 loss, and then broke down even harder the next day. And these are the retail sector alone was, I showed you Foot Locker and I showed you Macy's, but if you actually look at the consumer discretionary area, this was actually underperforming. So going into April 3rd, just like that, well off the highs there. So you knew this was like a laggard group. If you look at the XRT, you could see that it was just a little bit off its highs here. That's a retail ETF. So you can also see there was a big extension up here that you probably wanted to maybe focus on a short there. RTH is another retail ETF, which again is a lot more weaker, I should say, going into April 3rd. So again, this is the kind of way that I view these scans. You kind of have to look at the symbols, kind of know what industry they're all in, and take into context where the broader market is, and that's just going to kind of set you up for where you want to, if you see a reversal, you see confirmation, those are the kind of low risk trading opportunities that I know I particularly try to identify. To move on to some more scans, let's see. Let's see. So we did overbought. Oversold's the same way. I mean, you kind of get the gist there. Right now, they're going to see a lot of, probably biotechs and some technology and some internet names. They've been hit really hard here the last couple of weeks. So they're probably going to start showing up. I'm not really going to be buying them unless there's some sort of gap down reversal day. And, the one thing also to mention gaps, the best ones are usually the ones that have no news. So, like, for example, when J.P. Morgan reported earnings a couple days ago, the entire market opened lower, but yet immediately buyers stepped in on a whole other range of stocks for a really nice day trading opportunity where they actually managed to rally a lot of other stocks for a couple solid gains. So it's kind of like if there's news involved, it kind of negates the technical pattern. I joke around with a couple of people sometimes saying that fundamentals are only good 4 times a year when earnings come out. When earnings come out, the fundamentals, they completely override the technicals, in my opinion. You're talking about massive amounts of hedge funds and mutual funds and all of Wall Street that's geared towards fundamentals. For that one day, they're going to be making decisions based upon the fundamental news of earnings, that day, as all the ratios have to be adjusted, et cetera. So the technicals kind of have to take a back seat to fundamentals 4 times a year. However, all the other days of the year, technicals to me are a key component, and following the trends and following the levels are pretty much the only way to go. Occasionally, you get an upgrade and downgrade from an analyst out of nowhere, and you have to kind of just take it for what it is and deal with it and see how the reaction is to the technicals that are in play. All right, so not to digress. I'm going to skip this middle area here. This is called Inside Days, Inside Weeks, Doji Days, and Doji Weeks. And I'm just going to jump up to Power Ups and Power Downs. These are very similar to the Overbought, Oversold. However, except instead of being extended on a 5-day average range, it focuses on more of the stocks that are running for 3 days higher or 3 days lower. And essentially, this was designed to just try to find a strong momentum where, there's volume. There's a little bit of volume in the calculation there. So you're trying to find stocks that are really being accumulated over the course of 3 days or being distributed over the course of 3 days. I would love to say that, you can just jump on board these things and make money on them. Unfortunately, they're just a lot of power ups and power downs eventually will turn into what I call shallow pullbacks and shallow pullback shorts and longs. On that when they do pause. So you always kind of want to. This is kind of like almost like a heads up or a lead in or almost a transition into the pullbacks that you're going to see up here. And those are going to be your better candidates if you can keep track of them. So that's basically what it goes for. You don't really want to fade. I wouldn't really recommend trading them. Again, you have to take them into context. Where is the broader market at the time? If I have a bunch of power downs and the market itself is, say, at the upper Bollinger Band, I'm not buying these power downs because I know the market itself is going to come in, and the power downs are probably going to continue lower for a 4th day or a 5th day. They're the laggards of the group, and vice versa. If the market starts to rally and bounce, I want to be long. I want to be long some sort of power up move in the stock in this group. That's going to move me up to shallow pullback, shallow longs, and plenty of examples here. This is actually one of my favorite patterns here. So essentially, you're going to be focused on the trend of the market. And again, I know I'm beating a dead horse here on this, but you have to take into context the market, the individual sectors, and then you have to look at the stocks and see where they are. Generally speaking, again, this is just a computer just spitting out the price patterns that I've inputted. It's essentially just looking for stocks that are making higher lows in higher lows in a downtrend or lower highs in an uptrend. There is a volatility factor involved as well as volume with all the scans. Otherwise, there'd be way too many. I try to keep the results to 20 or less for the most part. So again, you just have to kind of look at each one. And again, I'm always looking for some sort of theme among them, or seeing if there's an ETF that stands out. So just looking at today's, I do see a couple staples setting up here, pullback longs. This one stands out to me, HCA and WellPoint. Those are two medical providers, or healthcare providers, I should say. Staples would be a WHR, and Clorox. Maybe an energy name, and I know energy's been strong lately. Ideally, I would have liked to have seen maybe a utility in here, because I know the utility sector is really strong. So I'm kind of keeping the themes and the sector's strength and weakness in my mind all the time. A few days ago, I think it was April 8th, if I just go back a moment, we should have had a ton of pullback short setups among biotech stocks. And I can't remember specifically what day. I want to say April 2nd. Yeah, so here, April 2nd, again, the market was at its highs, ready to come off. You could see CRM is a software name. CSIQ is solar software, Facebook software. Lumina, INSEE, I think those are technology, biotech there. Jazz is biotech. Now, software. Qhu is another internet software, technology-based, 3D printers. Biotech, again, Workday is a software stock. Yelp is an internet software name. Again, you can see a theme here, software, internet, technology. And if I was to pull up any of these charts, let's just look at, I think I actually took some of these on the trading service. Yelp is a good example. So back here that was for the scans going into April 2nd. Just a strong downtrend, stocks trading below the 20 moving average, the 50-day moving average, and you could see it was set up as potential bear flag pattern, and it gapped up, reversed outside day. We took a short in the name right here around $77, I think, when it took out the low for the outside reversal pattern for swing short. It already had tested this blue moving average, which was the 100-day, for multiple times. So this was a signal that it wasn't probably going to hold it for the third or fourth test, and that it could potentially break down. And we've actually still sitting short with this trade for looks like about a $17 gain we've had in this name, and we're just kind of trailing our stop loosely around here. So that's one of them. VRX was a biotech stock. Again, if you didn't know, you just look at the IBB or the XBI. There was a very aggressive breakdown in late March. You did get a slight bounce, and going into April, you could see that there was a bounce here. So this was going to set up a number of pullback short candidates in context of being below the 20-day moving average, below the 50-day moving averages, and VRX was one of the ones that was on that list. And you can even see my entry point right here. So this was also an inside day bet on that scan that day. You can see it was rejected against the 50, rejected against the 20-day moving averages right here. And then when it started to break down below 132, this is the 2-day lows here, we got short, and we wrote it down for a nice gain. It bounced back a little bit, but we maintained our balance stop up here, and we're still sitting short a small balance of it right now. So those are just some examples. I think it was CRM was another one, a software name here in early April that was set up as a pullback short, again in context of a downtrend below the 20, below the 50. You could have looked at the IGV, which is it's a software ETF. So again, IGV, if you didn't like to take the risk on individual stocks shorting, and you feel more comfortable shorting ETFs, here was a nice one right here. You could have drawn a trend line just off the highs, so you knew you had a low-risk entry point right here on the gap-up reversal, and the stock started, the ETF started breaking down significantly the next few days for some solid gains. I think Qhu was on that list as well. And again, most of the market broke down aggressively here in early April. But you can see that the TA scans, that's what they're designed to do. They're designed to, capture and identify these types of setups, especially when and again, the theme. I can't repeat this enough. When I see themes in sectors and certain groups showing up, you have to take notice of that. That's where the opportunity lies. When you start seeing all this and you start shorting stocks like Microsoft, or start shorting an energy stock because you think it's overbought, you're not putting the odds in your favor, or utility stock or something like that. You just kind of you're still betting against the momentum. So you kind of have to, you're always better off putting the momentum in your favor when you can, and that's what these scans are designed to do, to give you that sense of where you should be focused on each night. If we go back to today's scans, let's see. So this last one I want to cover here is the LQDXX pullbacks. I'm going to hold on one second here. Okay, sorry about that. So the LQDXX pullbacks, this is basically, LQDXX stands for liquid momentum, and that's based off the proprietary focus list that we came up with that's offered on our Briefing and Play Plus service. And essentially this is designed to identify the strongest fundamental and technically oriented stocks in the market at this time, or on a week-to-week basis, I should say. It's the top 50 stocks that we identify, that are leaders in the market. So whenever I'm very familiar with these stocks, I have to input them in and out each week, and I look through all the charts, and I usually try to focus around most of my blue chip trading calls on these stocks. So whenever I see any of these names show up on the scans, I definitely take extra attention to them because I know they're leading stocks. So in a webinar I did about a month ago, one of the strategies that I do like to deploy is when RSI 5, not the 14, 5, becomes oversold into oversold territory. I want to start looking at buying these leaders on the dips. Essentially, I don't know if anybody's on the line here, but if you can mute your phones, that'd be great. I think I heard an alarm or an ambulance in the background. So basically on these leaders, when they pull back, I definitely want to be focused on some sort of support level coming into play, whether it be a multi-week low or a multi-month low or a trend line or a key 50-day moving average. If as long as the market's intact and there's still you're still seeing strength amongst small caps or the particular sector or industry, these are going to be a group that you want to watch. Now on the opposite side, what I've also noticed too is that when this list starts to grow, when you start seeing well over 10 to 15, sometimes even 20 names of RSI 5 dropping below their, the RSI 5 dropping below into oversold territory, it tells you the leaders are under attack. There's something going on here, and the market is selling off these leaders significantly, especially if you start going through them and you see them all dropping below their 50-day moving averages without any sort of bounce or rally in effect. And that's really kind of what we've seen here in April. You can see the list has grown to probably about 12, 13, 14 names. And obviously these leaders are getting distributed, and it's making the way for new leaders in due time. However, I also know that in confirmation with, knowing the momentum has turned down, seeing the wide range breakdowns has increased over the last few weeks, seeing oversold names have occurred, have been on the rise, power down names have been on the rise. Now I'm starting to see the focus list leaders, this is increasing. These are all signs and signals that the market is under distribution. And you kind of, like I said, this goes back to earlier when I said you want to kind of trade less frequently, maybe trade less often, or just change your entire strategy around and focus more on the short side if you want to be really aggressive. So that wraps up that scan, and I think we're going right on to the half-hour mark. Essentially, that's it. If you have any questions, there is a chat box on your webinar entry on your webinar page there. I can show a few charts. Hopefully, please stay within the confines of within the context of the webinar itself. Or if you have any scans that you've had any issues with, or any trades or sectors or anything else, I'll take a look at them. Let's see. Yes, this is recorded. All of our webinars are recorded, and they will be uploaded to our YouTube channel, which is Briefing TV. So if you were to go to YouTube and type in Briefing TV, you should take you to a series of webinars that we've done over the last few years. Let's see. Feel free to type in any questions if you can. I'm going to go back to just to sum it up. If I don't see anything, oh, here's another good example. This is how my mind works. So when I look at these screens here, so here's March 17th, St. Patrick's Day. I'm always looking for themes, like I said, and especially when I start seeing names that just the same symbols over and over and over again on certain scans, that's another thing you have to really be focused on. So I just basically circled. I see Amazon here under Inside Day, Amazon here as a doji, and Amazon here as a doji week. And like I don't know if I covered this or skipped this, but essentially these are pauses or rests in the current trends and in the current momentum. So for example, Amazon. Here you can see there was an inside day, inside week, doji week, and if I was to pull up Amazon here of that week of March 17th, here's the weekly chart on the left. This was going into March 17th week right here. This is a doji pattern. It's where the open and close are very similar to one another. That's not exactly a sign of a trend. It's a sign of indecision. It means that nobody really won. Buyers and sellers are kind of battling it out for control. Given it in context of where it was off a 2 or 3 week rally, it's possible you're going to see some downside correction or consolidation here, or possibly a breakout. We move forward to the daily chart over here on the right, and March 17th starts right here, and the price starts breaking down and breaks down below the 50-day moving averages, 20-day moving averages aggressively. Could have been a shorting opportunity for you there, and it's just really been struggling since then. I believe another one that was on that list was Biogen. Biogen looks like an inside week here on the left, and going into the week of March 17th, it did try to break out higher, and it finished the week actually very poorly, erased the entire inside week here, and could have been, just a day like this alone was a wide range breakdown day. It put the stock back near the 50-day moving averages, but it was also a reversal of an inside week, which is usually a very negative signal. And again, that was probably the start of the breakdown of the entire biotech sector, telling you that you should be getting out of your longs, locking in profits if you can, or even just start shorting them. Another good example, let's see if we look at that. Biomirin was another one. I have FedEx here, F5, Jazz. Jazz again was a leading. That was a leading Growex biotech name. It was a leading liquid momentum biotech name, and you could see that it actually started coming under a lot of pressure in late February with the biotech sector. And here was the on the left-hand side of the chart. You can see here this is the inside week that it had, and it was kind of like a triangle pattern that was developing in March, and then it just started breaking down aggressively below these 50-day moving averages here, below the 20-day moving averages. Again, all confirmation inside a weak biotech sector at that same time. These are the leaders that were breaking down. There's no reason to be buying these stocks at those times, not in my mind. Not when you have market breaking down, sector breaking down, individual stocks rolling over. Those are just complete avoids or shorting opportunities to buy puts on, or just somehow to get out of them, or to short them aggressively. And I could go through a couple more on the same way for software and for internet stocks. Actually, like I said here, there was a number of internet, biotech, and retail stocks, just consumer discretionary stocks kind of just rolling over out of these doji weekly patterns, doji daily patterns. So to sum it up, it's just, again, none of these should be taken by themselves. You always have to have some sort of bullish and, look deeper inside these scans. Find a certain theme. Find a certain sector. Focus on what's breaking out. Focus on what's weak. If you do see a scan that says none, I think that was another thing I want to cover. If you do see a scan that says none, don't just ignore it. Like right here, shallow pullback shorts and power ups. Right now, there's none. None is something. So that basically tells me that there are no stocks that are rallying in a downtrend, and there are no stocks that are up for more than 3 days or higher. That almost tells me that the market could be too extreme to the downside or too short-term oversold, and that some sort of bounce may be brewing. We do have an expiration week coming up in 2 days on Thursday. The markets are closed on Friday for Good Friday. So it's possible that there is some sort of short-term oversold condition going on here. And we have the IWO sitting along that 200-day moving average. Might start to see some of these small caps maybe come back and bounce a little bit. And that's the kind of way I'm reading into this market. So I know I don't want to be aggressively short anything when I don't see any sort of pullback short candidates or too many power down candidates. It's kind of have to take it all into context of where you are. Let's see, 1 day. Inside days, again, they reflect some sort of pause. The bottom line is just have a plan, trade a plan. On our briefing trader service, we are going to try to steer you in the right direction, or at least keep you on the right side of the market as often as possible. If you follow along with my blue chip trades, I do tend to be a lot more lenient with stocks. I look at the market in as zones and points and areas. I do not focus on nickels and dimes and quarters. There's just too much noise on those shorter time frames, and I'm always looking at the bigger picture, the bigger themes, the bigger levels, the bigger zones. And once prices start to react to that, it gives me this loose interpretation that allows me to just flow a little easier with it. So I do tend to be a little bit more lenient with my stops, etc. If you have any questions, feel free to send them to tapagescans@briefing.com. If you're not signed up for the service and you want to give us a trial, obviously you can contact our sales department at sales@briefing.com. If you have any questions or you have any ideas for scans or you'd like me to look into something, I'm always open to new opportunities, constructive feedback, etc. So just shoot me an email. Going through the questions again, doesn't look like too many poured in. How do you determine your trailing stops on swing trades? Is it based on a 5-day ATR? So trailing stops, it's tricky. Price action's key. So that's a good question because I believe I did give an actual on the trader service. I was actually I came up with an example. So I've been short Pandora for a while, probably the last month or so. And I think it does a great job at explaining how I manage trailing stops. And even though that's not really what the webinar is about, I'll just go into it real quick here because it is a really great example. So Pandora was had this bear flag pattern coming off a new high breakdown here in mid-March, and it was struggling underneath the 20-day moving average, was sloping down. The 50-day moving averages wasn't really kind of showing any sort of strong rally potential off the 50-day moving average here. It probed the 20-day moving average twice, and it just kept selling off really aggressive. So to me, that was just kind of set up for a short. RSI 14 was below 50. There's just a lot going on here. MACD, you can see, was already rolling over. There's just a lot of reasons why this stock looked like it was a low-risk shorting opportunity in this 34, 35 area. You could have put your stop above the week's high around 36. Stock started to break down. The rest of the market started breaking down late March. I take a partial profit of +4. Whenever I take a partial profit, I then tighten up my stops to break even. You want to let your winners ride. I mean, that's really kind of the way the whole idea of swing trading works. If you can maintain a full position as much as you can, but when I get a winner, I really want it to ride for as long as I possibly can, because you never know when that trend is going to end, either upside or downside. So we took a +4 profit here, and I guess most people would have been out on this day here as it started to clear, started to bounce and rally. In my eyes, we were already up about $3, $4, so I wasn't in any sort of rush, and we were below the downsloping 20-day moving average, which is this blue line here. So I was really kind of willing to give it the benefit of the doubt and wiggle room. The resistance area was probably off this low to this low. So right here around 33.50 was kind of the resistance area that I was watching to see if price would get back above 34. Well, then maybe I would consider covering the remaining balance that I had. On April 2nd, again, the market was overbought It was up really strong, so this was a laggard stock, and that's another reason why I wasn't really willing to give up the balance that I was trailing on this. Um, and again, this is all kind of discretionary trading. So and I was negative on the stock. I don't just as a whole fundamentally and everything else. So it was just kind of one of those things where I knew I wanted to be short for the bigger picture as well. I guess it was kind of a gut feel overall. So once it moved up here and it closed real aggressive back below the 20-day moving average and did like an outside reversal day here, that's where I definitely lowered my stop to. I mean, that was kind of a no-brainer. Any sort of outside reversal bar is where you definitely want to, let me rephrase that. So when a stock is in a downtrend, it should be acting bearishly. When it doesn't act bearishly at the right places, something's wrong. And when I notice when that something wrong occurs, that's when I want to get out. So in this case, this stock is acting perfectly normal in a downtrend with an outside reversal bar failure at the 20-day moving average. It dropped down lower, bounced off support, bounced for 2 days, and then there it is again, probing the prior day's high underneath the 20-day moving average, aggressively selling off for an outside reversal day. That's normal in a downtrend. That's where I want, if this was to fail, if stock price was to do this and then come back up through that level, well, then that tells me something's awry. Something's not working. The stock's not acting as bearish as it's supposed to be in a downtrend. So that's why I've tightened up my stop down to there. Arguably, I could, we caught this further move down here. Today, it kind of probed it here. It looks like only for like, I don't know, a nickel or so. It's not really anything I'm concerned about. Again, I don't trade nickels and dimes. I look at a lot of charts. I look at the whole figures a lot. So if this stock starts trading above 27, 28, it's still under the 20-day moving average. I'm going to give it the benefit of the doubt unless there's some sort of massive squeeze up here. But if there's a failure in reversal and it creates like this swing high type of move, that's where I'm going to trail my stock and lower it down. But generally speaking, when I start off in a position, I am looking at the ATR of the stock, and in which case this is the average true range is was probably around somewhere around $1.75, $2 for the stock. So for initially, I'd say I use the ATR as a risk parameter, and as the stock drops into my favor, you want to tighten it up. But I also look at the technicals and I look at the patterns that are developing to try to stick with the longer term momentum. On a short, what moving average do you want to see price below 20 or 50? I kind of just answer that. Usually when I'm shorting stocks, I want to be below the 20 and the 50. Once you start getting in between the 20 and the 50, it gets kind of sloppy, and it becomes this battle that you kind of have to see which side emerges. But technically, I really do want to be focused more on the bearish patterns and bearish setups above the moving averages, above the 20, above the 50, and below the 20 and below the 50-day moving average. Be on that same side, be on that same trend. And that goes to the same with these TA scans. When you look at these scans, again, the computer's spitting these patterns out, just the price patterns. So right off the bat, if I look at these shallow pullback longs, all these stocks, I mean, they're not all going to be above the 20 and all be above the 50. And to me, when I go through those are the ones that I'm eliminating right away. I'm not even going to bother looking at them. Now, the ones that are above the 50-day moving average are the ones that are in context of an uptrend of sorts. I see Whirlpool was on there. All right, so Whirlpool, had this little pullback action here last few days, and it's above the 50-day, which is the green line, and it's above the 20-day, which is the blue line, and it started rallying out today. So to me, this is a pullback. It's trying to rally higher. If the market itself is actually going to have any legs here after today's afternoon rally, well, then maybe there's some upside potential here for a trade back up to the 155 area, over the next 2 days. That's pretty much it. I don't see any more questions coming in. I do want to wrap up the webinar. I do tend to make them longer than necessary. So hopefully you got something out of it. And if you have any questions, please email me. Thanks a lot. Have a good evening.